And I'd say that the biggest thing, like the most important and largest potential cost someone has when buying, or not when buying, but when getting a mortgage, is the potential prepayment penalty.
Have you been thinking about buying your first rental property for some time, or do you already own a bunch of properties? Well, fellow investors, you found the right location to listen and learn from others' successes. Welcome to The Very Real Estate Effect with your host, Axel Monson.
Hello, and welcome back to The Very Real Estate Effect podcast, a show dedicated to real estate investing right here in Quebec. And today, it's a pleasure and an honor to have my friend Mathieu Poupart on the show. Hi, Matt. Welcome on.
Thanks for having me. It's a pleasure to be here.
All right, man. So before we jump into it, thank you for sharing this episode with a friend who could benefit from this conversation. Mathieu Poupart has now been a friend for about 3 or 4 years. We met at some of the events that I held and then plenty of other occasions. He is a top, if not the top producer at Orbis Group. Orbis is specialized in mortgages, and you can tell us a little bit more about that. And we've been kind of touching base once in a while and seeing how things are going. And he's helped actually some close people, close friends of mine and family to acquire and finance property. So thank you for that. And as a top producer on the mortgage side, you are right now in a bit of an interesting situation. And I'm so glad that you're here so we can talk about this. So Matt, without any introduction, like, what are you seeing and how's it going right now?
In Montreal, it's actually going quite well in terms of the housing market. Mm-hmm. You know, I think, and we were talking about it a little bit right before we got started, but in Montreal, we're actually really, really lucky that the housing market's continuing to kind of remain stable, but also increase slightly for certain segments.
Yeah.
Because the truth is the rest of Canada, and not all of Canada, but I think it's about 3 out of 4 major markets in Canada are actually suffering right now. You know, like the housing prices are coming down. And so I'm, grateful that in Montreal, it's the opposite and we're still seeing kind of increases. Now, in the spring in Quebec, it's always extremely busy because we're the one province that has the June or July 1st kind of move-in date.
Yeah.
And it's kind of outrageous because we do more than half our business in a 3-month period, which is good and bad. Mm-hmm. But no, it's good. The market's been going well. And, the big difference is the uncertainty with rates. Yeah. It's really kind of difficult to tell a client or to help a client decide on whether to go fixed or variable based on expectations, because we just don't really know if rates are going to go up or down in the next 12 months.
Mm-hmm. So before we got started recording, we obviously couldn't help ourselves but start chatting about all this because we love it, we care, and we're passionate. And we were just you mentioned the phrase like the most uncertainty. I mean, we all know what's happening in the US. We all see the impact that it's having for us here. Let's go dive into the details a little bit to be able to set the stage, maybe at the macroeconomic level, for those who are listening, and how that's impacting us here.
So I think the biggest thing, and it's the big talk, and I really hope this kind of blows over and just gets kind of nullified in the sense that it's tariffs, right? So how can any business operate not knowing what their cost of goods are going to be, or potentially, having a bunch of their exports just slashed in half or worse because tariffs are being imposed on the goods that they try to export? So for any business, for any country, you can't operate with the uncertainty of not knowing if any tariffs at all are going to be imposed, or if it's going to be 10% or 20% or whatever it may be. So because of all that uncertainty, how can economists try and come up with models to predict how the economy is going to do? And they look at the worst case scenario, they look at the best case scenario. It varies wildly, but it's not good in any case. Mm-hmm. So it's just until that kind of gets settled and really gets set in stone, there's uncertainty. Yeah. Not to mention that our wonderful country, unfortunately, has had negative GDP per capita for the last couple of years now. So it's, it's not something we really hear about in the media because they look at the technical definition of a recession.
Look at the overall. They don't look at on a per capita basis.
Exactly. Yeah. But the truth is, Canadians are poor per person, and we haven't for the last 2 years. Yeah. So it's tough. It's not ideal. And we have a ton of potential, which is, it's important to kind of keep in mind. But yeah, so the uncertainty is the biggest thing. And until tariffs kind of get settled, it's going to be a little more difficult to predict which way we're going to go.
And just to go back to the macroeconomics point, the So down south, now Mr. Trump is saying, okay, tariff as a negotiation tactic. He's trying to choke the Canadian economy. It's putting a lot of uncertainty out there for businesses and consumers, as Matt just described. Now, tariffs, if we have to start paying more for our products, it's naturally going to fuel inflation. And in order to fight inflation, the Bank of Canada has a target between 2 to 4%. And in order to fight that and rebalance and stabilize inflation, they're going to have to raise rates. Now, as there's uncertainty, people get scared and they consume less. So we also need to foster domestic consumption. And that's done usually by lowering rates because we want to encourage investment. We want people to buy new houses and new cars and go get some financing and so on and so forth. And so, as you said, like for the Bank of Canada, and I was reading a report where up until a couple of weeks ago, it was 80-20, the proportion, the likeliness of another rate cut. Whereas now, I think it's close to 50-50 of on the next cut, is it going to be a cut? Is it going to stay as is? Or is it going to be an increase? And as you just said, like, this causes so much uncertainty that now everybody's on hold.
Yeah, everyone's on hold. And the truth is, you know, we look at the odds you just mentioned, they changed quite a bit and pretty quickly. So I think as of this morning, they were down to like 32 or 34% of no rate cut on April 16th. And those are market implied odds. So it's how bond traders trade based on what they expect the Bank of Canada to do.
Yeah.
At the same time, although there's no rate cut predicted for April, as of right now, and that can change in a week or two, you know, they could go jump up to 80% chances of a rate cut. They are trading as if the Bank of Canada would cut another 0.5% in the next 12 months. Okay. So although they might pause in April, they might decide to cut at the next meeting. But then again, those predictions change all the time. And the truth is, like, economists, I love them because I love reading what they have to write and say. But the truth is that economists are terrible at predicting what will happen, just because there's thousands of variables that change their models on a dime, and they're incredible at explaining why something happening. But when it comes to predicting, especially, you know, interest rates, it's impossible.
Yeah, it's really difficult. And you know, and then people, it's almost misleading because people are like, oh, but the Bank of Canada just cut rates. Yeah, but the bond yields are going back up.
Right.
And so what kind of indicator would you suggest that listeners look at in order to get a better indication other than just the, you know, prime rates?
So the biggest, like you said, is the bond market. So the 5-year government bond yields, and the yield is what it is. It's the yield. It's not the price of the bonds. But when the yields go up, you can expect that eventually the fixed interest rates will follow. And it's an important distinction because although the media talks about rates coming down right now, they're referring to central bank rates. So the Bank of Canada overnight rate. And that rate has a direct impact on the variable mortgage rates. So the variable rates are coming down, but the fixed rates started coming down a year and a half ago, and the media wasn't talking about it. And the truth is that it's fairly common for the fixed rates to increase slowly while the Bank of Canada is still cutting. So even though the media might be talking about rates coming down, maybe fixed rates will start going up. And they haven't yet. They're relatively stable right now. They've even been trickling downwards. But that shift will happen eventually. You know, is it in 6 months, 12 months? We don't know. But it's just important for anyone buying or investing in real estate to be aware that, you know, because the Bank of Canada is cutting doesn't mean fixed rates are also coming down. They can be going up. So you just have to be really careful.
Yeah. And then in the choice, and then coming to your lovely profession of, I bet people ask you right now, should I go fixed or should I go variable?
Yeah, every day.
It's so hard. What do you, how do you answer that?
It really depends on the person's objectives. You know, someone who's buying a home that they know they're going to live in for the next 5 years will have a different kind of answer than someone who's looking to invest in a property, who has chances of maybe flipping the property within a year or two, or maybe refinancing. You know, those are really important things to keep in mind. And I'd say that the biggest thing, like the most important and largest potential cost someone has when buying, or not when buying, but when getting a mortgage, is the potential prepayment penalty, right? So with a fixed rate, if you break a fixed rate mortgage early, you can and you will pay a prepayment penalty. And on a fixed rate, especially with the big 6 banks, can be massive.
Yeah.
We're talking like on a $800,000 mortgage, we've seen penalties of like 45, 50K. Yeah. You know, it's a huge amount. So if you wanted a fixed rate for the peace of mind, but then you end up paying 40K in a penalty when you break the mortgage, you know, that backfired. So that's the biggest thing. It's mitigating the potential prepayment penalty. After that, it's, you know, are you going to sleep well with a variable rate, knowing that you thought the Bank of Canada was going to cut on April 16th and finally they paused.
Yeah.
If you're still going to sleep well and you won't,
And on a 5-year term, like things can change after a year or two. And so now, I think, rates are going to decrease. I'm going to go variable. But what is it really going to be like a year and a half from now?
Right. Exactly. So it's more about your strategy with the property you're purchasing. I think of someone I know right now purchasing a home that they will probably sell in 3 to 4 to 5 years. Well, don't go for a 5-year fix. Even if you intend to buy another property afterwards, like you don't know what the timeline's going to be. Life happens. Yeah. You want to just avoid that potential prepayment penalty at all costs. So whether that means going variable or maybe going with one of the non-banking financial institutions that has usually a much lower prepayment penalty, I think that's important to keep in mind. And that's really should be the deciding factor, not the rate that's 0.05 or 0.1% lower with one bank versus another.
You just said something really interesting. Like some of the other lenders that are not the top banks have lower penalties, even though, correct me if I'm wrong, but in the end, all those institutions, they bundle up the mortgages into a $250 million product that gets resold on the secondary market. So are the big banks kind of taking advantage of us?
It's not that they're necessarily taking advantage of us, but they understand that if you went for a 5-year fixed at 4% today, and in a year and a half, the 5-year fix was now down to 2.8%, you're going to want to break that mortgage and sign on to the new 2.8% rate. So they need to cover themselves. By going with a fixed rate, the bank is the one taking the risk. So they're going to protect themselves from you breaking the mortgage, and they're going to recoup their cost. They're just, it's good business on their behalf. It's not ideal for the consumer.
No.
And then the monoline lenders or the non-banking financial institutions, it's really interesting because, and I think this is what you were kind of alluding to in a sense, is that the money that the monoline lenders are lending out also comes from the big banks. And like
it gets bundled in the same way afterwards.
It's the same money. So it's just kind of interesting. But it also has to do with how, their cost of funding, how much it costs for them to fund the mortgage, at what point they're making a profit or at what point their margin is kind of acceptable for them. And they still, if the rates change enough, like there still will be a big penalty with the monoline lenders. Yeah. It just might not be as big as it would have been with the big 6 banks.
Okay. And right now, would you, as an advice to a borrower, would you encourage them to go with a non-traditional 6-bank lender?
Rates being equal or close to it, if you're leaning towards a fixed, there's a massive advantage in going with a non-banking financial institution. Unless you wanted a home equity line of credit with the product and the monoline didn't offer that, there's no disadvantage really to going with a monoline lender. There are more restrictive products, so you do have to be careful. You always want to look at the terms and conditions to make sure you're signing on to a product that you kind of understand and know all the ins and outs of. But all, rates being equal, it doesn't make sense to have that potential massive penalty and that potential huge cost that would, in many cases, kind of limits you and is the deciding factor in am I going to sell or not? No, because there's a massive penalty.
And then so let's say someone owns a condo, they've had it for 10 years, their 5-year, the end of their term is coming up, and they like to go to one of those non-traditional. Do they need to requalify there?
So anytime you change lenders, you are requalifying. However, the government smartened up a little bit, and now you don't have to qualify at the stress test rate.
Okay.
So if you were going to get a rate of 4%, you'll qualify at 4% instead of having to qualify at 6%.
Okay.
Which now kind of evens out the playing field to you switching banks, because if you didn't qualify at the stress test rate, you'd be limited to your one bank that you already have the mortgage with, because they have to allow you to renew. So it's yes, it's a little more work, but it can definitely be worth it. And then that's the idea, right? You do the analysis, find out how much you'll save or not save, and then you decide. Yeah.
So a lot of uncertainty coming from down south. In Canada, the economy is questionable. We also have some elections coming up.
Right. Yeah.
Another curveball. It's such a wide question to say, how do you see this coming in the next 6 months? It's just, let's be very concrete and action oriented here. When someone calls you this afternoon with a new file and be like, look, I want to buy this property. It's a duplex. It's a single family home. What are some of the first, I wouldn't say warnings, but caution signs that you share with your clients?
I think, especially now, I think this is, always the case. It was kind of a harder argument to make in the middle of the pandemic market, but it is, speculating is it's tough. Like, you don't want to buy a duplex thinking that in a year or two it's going to be worth that much more because you held on to it, especially now.
No.
Like we're seeing in 3 out of 4 markets in Canada, like it's not, it's the real estate market's not going great. So definitely speculation, try to stay away from it at all costs. And then it's about, we don't know where rates are going to be. Are they, they can end up being 1% lower than they are now, but they can also end up being 1 or 2% higher than they are now. Yeah. We're in a situation where the governments have been talking about, subsidizing companies that are suffering economically from these tariffs. And the last time that happened was during COVID. And we all know what happened to rates, right? Like they subsidized so much. Yeah. The Bank of Canada cut a ton. We ended up at almost 0% interest rates, and inflation skyrocketed, which was a disaster. And the Bank of Canada didn't do a great job, and they've admitted it, at kind of mitigating inflation, and they had to increase rates like crazy.
Drastically. We went from like one opposite to the other in a 2-year period.
Yeah. After confirming to Canadians that they wouldn't increase rates for a 4-year period, that same year, they increased them by close to 4%, So I think, and I hope they've learned their lesson. I really do.
It's still fresh. We can hope, but we've often been disappointed.
Yeah, and I think that's the kind of cautionary tale that, like, even though, regardless of what they say, you just have to be careful and not necessarily bank on interest rates, being the same as they are right now in a year or 2 or 3. So it's, you just have to tread carefully right now. Make sure that you can afford a higher interest rate if you end up renewing in 3 or 4 years at a higher rate, because it's not impossible,
No. So when you get new files, what are the top elements that you look at to see if you can even take this on as a client and try to push it to financing?
Right. So, I mean, the biggest thing is your debt service ratios. So qualifying in terms of looking at your gross income versus the expenses created by the property you're purchasing. And they don't look at all of the actual expenses of a property. They'll look at the municipal and school taxes, condo fees, if there's condo fees, heating costs, and mortgage payments. And in general, you're limited to about 39% of your gross income for those expenses. Okay. But then they look at all the other expenses someone might have. And that can include a car payment, bank loans, balances on lines of credit or credit cards,
student loans,
everything
that goes with
it. And the biggest being car payments. Yeah. Having a $1,000 a month car payment can significantly impact your borrowing capacity. So we all want that nice big new car, but if you're planning on buying real estate, it can make a big difference on your borrowing capacity. Yeah. So I think that's a big one. And then, banks will also look at your ability and your history of paying back loans. If they see late payments, you're gonna have a much harder time qualifying for a mortgage.
That's credit score.
Yeah. Yeah. And in Canada, luckily the credit score doesn't necessarily dictate the interest rate you'll get. It can with Desjardins, but not with any of the other banks. Whereas in the States, your credit score has a pretty massive impact on the actual interest rate that you'll be able to get when you're applying for a mortgage.
I mean, in a way, it's not surprising. You do represent a bigger risk. And so proportionally, you're going to be paying more. I wasn't aware that there was such a big difference between US and Canada. Interesting.
Yeah. Yeah. Then the biggest being that, in the States, you can lock in a rate for 20, 30 years, which sounds kind of nice.
Yeah. Yeah. In Europe, it's the same thing. And for them, it's crazy to think that every 5 years or 3 years or what, you go back to you play Monopoly, you go back to the bank and you renegotiate and
you're subject to, whatever rates are available at that time. And that kind of plays back into this next election and whoever's running the country, because, what they do really does end up having an impact on the market conditions and the available rates for Canadians. And the truth is, mortgages are a massive part of most Canadian
of the debt. Oh yeah.
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 Yeah. So when interest rates go up to 5-6%, it's changes everything.
And right now it's also that we're towards the end of the 5 years of everybody doing mortgages during COVID.
Right.
2020, 2025. So we're there. So technically we're starting that cycle of all those renewals much higher than what those were contracted at 1.5% back in 2021.
Yeah. There was a lot of talk of that big renewal wall and that creating, a problem, because like you said, a lot of people had a rate of 1.5%, 2%, and now they're renewing luckily closer to 4%, but it looked, 6, 7, 8 months ago, like they might've been renewing at 5%. Yeah. Luckily all those people who bought with a rate of 2% or around there were qualified as if their rate was, closer to 5%.
Mm-hmm.
So that makes a big difference. And incomes have also increased quite a bit in the last few years, so they've been increasing. I don't know what the exact percentage is, but I think it's like almost 4% a year. So it's, incomes have been increasing quite a bit, which helps take the hit of those potential higher mortgage payments. And, you also have to remember that there are ways to kind of mitigate and lower that monthly payment. Like if you had 20 years left on your mortgage, you can reamortize to 25 or 30, and it makes a big difference on your monthly payment.
Mm-hmm.
It's not necessarily ideal depending on the property, whether it's an investment or primary residence, but there are ways to help. So, I don't think we're going to see mass kind of sell-offs of properties because people can't afford them. We do hear of stories here and there, but it's not what we.
And it's not like bank repos have exploded either.
No, they are increasing, but it's not. They're still very, very low.
You mentioned a point that got me thinking about actually a situation that we have is that we have a 5-year term that's coming up in November. And I've been thinking of calling the institution much earlier. Correct me if I'm wrong, but I think it's 3 months before, huh?
Even 4, yeah. Even a bit earlier, like there's.
Because now, with this conversation, I was thinking about it last week of like, hey, I should just, open the negotiation because we might be better off getting a term now than in September.
I think so. Yeah. Same for us. We have a mortgage coming up. I think it's in December. I've already been in touch with the bank, like trying to see like what they're willing to do if we renew now.
Yeah.
It's a bit too early, but for sure in the next couple of months, like ideally, I think just to be safe,
mm-hmm.
and we might end up being wrong, but I think in a time like this where there's so much uncertainty, you kind of want to mitigate risk. And, if you lock in at, 3.9 or 4% instead of 3.8 or 3.7.
Yeah, no, exactly. I just want to sleep peaceful. And that's the thing. Like we've had this conversation together before we started, and I've had it dozens of times, and people telling me like, yeah, but Excel, on a 30-year period the variable outperforms the fix. It's like, yeah, but I want to sleep at night, and I invest for a 5-year term, and I don't mind locking in even if it's a bit higher. And this one that we have the renewal coming up in the fall, it was at 1.7%. Yeah, we're going to be around 4% now, but the property is cash flowing great. I'm totally okay with it. I just want to know what I'm getting myself into for the next 5 years.
Yeah. And that's it, and like we said earlier, like as long as you don't have that potential prepayment penalty, as long as it's a property you'll be keeping for the length of the term,
mm-hmm.
It's nice to sleep well,
Yeah. You got to buy peace, huh, sometimes?
Yeah, and that's what it is. There's a premium on the fixed rate. Like even though it doesn't feel like it right now because most fixed rates are lower than the variable rates being offered, there is a premium baked into that fixed rate. Like the bank. The bank is
they put a buffer for themselves.
Yeah, they're good at math,
Yeah. In simple terms, thanks, Matt.
Yeah.
Banks are good at math.
Yeah.
And sometimes we feel like we're on the other side of the equation and getting the short end of the stick.
They know what they're doing. Yeah. So it's, there is a premium baked into that fixed rate, but you pay that premium for the peace of mind. That's what it is.
Totally different subject now. You had recently published on social media that Orbis Group that you've joined a while ago now. You've been with them for since the beginning?
5 years, yeah. So almost since the beginning. I think I was broker number 8 or 9, and now we're nearing like 150 brokers.
Wow.
Yeah.
And that you've also recently opened down south in Florida. Interesting times. Couldn't have known.
Yeah.
So the group has significantly expanded and even in other provinces.
Yeah. So Orbis Mortgage Group has expanded across Canada, which is for a mortgage broker in Quebec, I'm licensed in Ontario as well.
Okay.
But now to have resources in other provinces where if I have a client who has properties there, I can help them renew or purchase property over there by referring them to the right kind of team. It's a huge advantage. And then we're the only brokerage in Canada that also has a brokerage in the US. So for Canadians looking to buy in the States,
that market is fantastic for you guys.
It's amazing. And it's actually surprising how simple it is for a Canadian to qualify for a mortgage in the States. It's
just walk us through it. Is it okay? So let's say I'm here and I want to buy a condo in Fort Lauderdale, out of all places.
Yeah, classic.
Classic. How does that work?
So it's before having access to the products that we have access to now at Orbis Mortgage Group, I think a lot of Quebecers, for example, would go to Desjardins because Desjardins will finance certain properties over there.
The biggest branch of Desjardins, by the way, is in Fort Lauderdale.
No way. I didn't even know that. That's hilarious. Yeah. That's so funny. So now we have access to lenders in the States that are willing to finance Canadians purchasing in Ontario, or not Ontario, in Florida. So you're not limited to Desjardins and the rates they're offering and the minimum down payment they might be offering. And full transparency, like I'm no expert by any means.
Yeah, so, but you know more than we do. So.
Right, yeah. But it's nice to have options, and it's nice to know that you're not bound to one bank here in Quebec
Yeah.
now or one credit union.
But okay, but so someone who lives here in the greater Montreal region who wants to buy that condo in Fort Lauderdale, can they go and finance with a Canadian bank, a TD, RBC, CIBC, and all that? Will they support that type of?
Not all banks, no.
No.
So that's why a lot of people just go straight to Desjardins. But that's why being able to work with U.S. financial institutions gives you so many more options.
Yeah.
And makes it a lot easier to qualify in a lot of cases.
So then it would be financed through a U.S. institution, and in order to qualify the borrower, they're going to be looking at his assets in Canada, his income.
Exactly. They look mainly at the gross income,
Yeah.
and then whatever property you're purchasing. More often than not, they're also considering potential rental income, even though it might end up being a secondary residence, which tends to really help qualify.
Wow.
Yeah.
I'm sure you're not getting that many requests right now to buy a condo. Well, I don't know.
We're getting less than we were a few months ago,
Yeah,
for sure.
exactly. But it's a cycle. It'll come back, and property prices might, decrease a bit, and a couple months from now, it might go back up. Who knows?
Yeah, and with regards to the whole tariff thing, like, I'm no expert, but I feel like it'll blow over. Like
it has to.
it's not good for the U.S. It's not good for Canada.
It can't last too long.
No,
because in the U.S. they're starting to suffer from that.
for sure,
Mhm.
big time. And it's not only with just less Canadians going to the U.S., but their businesses too. Like they can't operate that way either.
No.
So it's Well, I think we have spring, summer around the corner, and I think it'll be hopefully the same for.
That too
Trades.
shall pass.
Yeah, exactly, exactly.
Sometimes it's good to remind ourselves that it's all going to work out in the end.
Yeah, 100%.
Matt, for those who want to get in contact with you, what's the best way to get in touch?
The best way is by text or email, but my phone number is 514-519-1565.
Okay.
And if not, you can find me on Instagram, Mathieu-Alexandre Poupart. Send me a message, and
LinkedIn,
Facebook.
Instagram. Call the office. It's funny because I'm still a good old phone guy. And just pick up the phone. I'm sure you can find his, you Google his name, you find his contact, you just call him, and if not, talk to your lovely assistant. And
Yeah,
go from
exactly.
there.
I was buying a car like not too long ago, like a used car, because I don't want to have that big debt, so I could buy more properties.
Yeah.
And I told the guy, he's like, oh no, it's all good. Like just bring the cash like on the day of.
Yeah.
And I was like, you could find me so easily online. Like just look me up and you'll find me everywhere. I'm not going to screw you over.
Yeah, you can find me online.
Yeah.
Like 2 clicks.
Yeah.
So, well, today's age and technology, it's harder to disappear, I guess.
Big time.
Before we close, I have 2 shout outs. One is to Corey. Corey, I'm very happy that you're coming on. You'll be on soon. And then Jason, because you've been following and I love the feedback that you gave me. So thank you for your continued support. Matt, thank you very much for coming on. And because, as I said at the beginning, we've actually known each other for years, and this is years into the making. So thanks for taking the time this morning to come and share. And I know everyone learned at least one thing. And if they have any questions, they can contact you for mortgage.
Anytime. It's been a pleasure.
Thank you very much. As usual, keep researching your market. And I say make some offers. And I still say make some offers. Just make good decisions. Do your research. Thank you very much. And I'll talk to you next week. Ciao.